Welcome to the man in charge. And who is the man in charge? Well, the man in charge is Jesus Christ, who sits at the right hand of the Father. So we're in the tail end of June, and the first day of summer, June 21st. It is hitting us hard here in Texas. It's been over 100 degrees Fahrenheit these last couple of weeks. It's toasty. Praise God that I work in an office and the temperature is usually around -6 or 60 degrees Fahrenheit. It feels like it's negative in the negatives, but it gets cold in the office. So I'm thankful that I enjoy the air conditioning, but yeah, once I leave work, I could feel the heat and the mugginess of Texas. But anyways, it's the beginning of summer, and my birth month is in June, which I used to enjoy. I used to always look forward to June, even the June gloom. There was just something so magical about June. Not only because it was my birth month, but it was also the beginning of summer, and maybe because I was also younger, it was always very, very joyous for myself because people loved on you for almost an entire month, or at least it felt like it. But now June has taken a whole different turn. Now it's all about the culture of death, and it is a month that reminds us of what the state of the nation is in its moral landscape, which is it's a shame. I find it tough to enjoy this month as much as I used to, but nevertheless, it's still the beginning of summer, and there's plenty of joy to be found here at the tail end of June. But yeah, so today I do want to talk on a few things. Since we are going to be talking finances and personal financing on this channel, I did want to start bringing up a few books that I have enjoyed and also learned a lot from. And I want to share that information with y'all. The first book that I'm going to share with you guys is this book by an author, William Bernstein. Yeah, he is a neurologist, and I believe he also has his MBA. Don't quote me on that, but yeah, one thing that did catch my attention was that he was a neurologist. I also have a background trying to get into the medical field, and so this really caught my attention. So this book is called The 4 Pillars of Investing. And the reason why I thoroughly enjoyed this book was it's the categories that it brings out to describe the investing landscape. The 4 pillars are: number 1 is the theory behind investing. What are we looking at when we think investing? What are the numbers? What are the goals? What is it that is meant by investing? So it gives you a lot of information when it comes to the theory and what to look at when you're investing. And William Bernstein does focus on long-term investing, so that's his MO. So if you're looking to be a day trader, this is not the book for you. He is thoroughly against any form of day trading or any of that school of thought. But yeah, so that's the first pillar, is it's the theory behind investing. The second pillar, which I found very informative, and I had never really thought about investing in this way, but it's also the historicity of investing. When you look back at the economic cycles dating back to the early 1900s, even going into the Depression, we do see certain trends, not only on financial charts, but also on what the general zeitgeist of those times and how they correlate with financial trends. So there's always a boom in technology right before a spike in the market, and during recessions, there's also things that lead up to those points. So this book does a really good job on covering some of those trends and what to spot during a cycle. So it's very informative, and I thoroughly enjoyed it. It's been a while since I read it, but yeah, one of the things that I do remember is the psychological states of those times, and how those psychological states, those emotional states, end up affecting the market. Which leads me to the third pillar. So it's the psychological facet of investing. Many of us know that as creatures, we are wired in a way that we react emotionally to certain things. It generally, when we're talking about the market, our general response to a trend is out of emotion. For example, if there is a bull market and we see things going on an upward trend, prices are increasing, there's more participation in the market, then that attracts people to get into the market. It's just a normal response. But what this book taught me was that in order to be a good investor, you do have to adopt a contrarian sort of sorry, excuse me, I have something in my throat. Yeah, to be a good investor, one has to adopt a contrarian mindset in order to have some long-lasting impact with in your financial life. So when there is a bull market, since our general response emotionally is to not miss out, we should be doing the opposite, which would be to not participate in the market, as much as it may hurt us emotionally, or like I said, it feels like you're missing out. But we're actually avoiding our financial gains to start being stripped away by things unknown, like there may be a war, there may be something that we just can't control that will cause a turn in the market. And it also goes the other way. If prices are low and you see a depression in the market, our automatic response is to not participate in the market. It is a scary time to do such a thing. Like, why would anyone with their faculties say, "Hey, I will participate in the market even though there's a recession"? It's not intuitive. So, what do you do when there's a depression? Well, that's when things go on sale. So this is what this book also addresses, is the psychological facet of investing. Now, the last pillar was the business side of investing. So when we invest in a company, we're not just investing on a arbitrary brand name. There's actually a business behind those names. There are, since companies that are on in the stock market are public companies, there is information that we can obtain from these companies and analyze them, analyze their financial sheets, their balance sheets. Are they profitable? Are they spending too much money? Where are they spending money? Are their costs too high? Are they profitable? What is their price to earning ratio compared to other competitors? So there's plenty of information that can be gathered from a company to make a good and proper sound decision. So those are the 4 pillars, and I learned a lot from this. I believe it's 360 some pages, and it's a very easy read. There's a lot of information to gather, and I would recommend it. It really did help me when I first looked into picking stocks. And this book will not really show you what to do when looking for a stock, but it does show you what long-term investing, what it does for an investor. And it is a very conservative approach to investing, but I do recommend it since it does give you that foundation to make sound decisions. So that's one of the books that I read when I first started stock picking. I did want to have a good foundation on the conservative approach to investing, and once you get that foundation, and you have a proper understanding of conservative investing, then you can start going in a more riskier route with individual stock picking. So that's one thing I wanted to show y'all. So I also want to show you this. I think I found this on online. I thought it was pretty telling of our current financial state as a nation. So this is a Forbes pie chart that addresses, it's not addressing anything. It's asking a question. What would you do if you received $5,000 today? So according to this pie chart, and I'm assuming that this was a survey that was sent out to people within this nation. And if we look at it, it is very telling on what the average American would do with $5,000. If we look at the biggest slice, we see that most Americans would put $5,000 into a high yield savings account. Right now, I believe the savings rate for one of the bigger banks is hovering around 4.5%. plus or minus 0.5%. So that's an adequate return on your cash, but it is a very conservative approach since the market has been coming back, and I would consider that the market is no longer in a bear market, but I think we're going more towards a bull run, hopefully. But regardless, savings is a correct way of approaching your cash, but it may not be the optimum for your cash. But if you look at this second biggest slice on this chart, it says to pay down debt. Now, debt can be viewed in many ways. It can be viewed as a financial leverage to your resources, or it can be viewed as a total liability, and rather than it benefiting you, it's actually harming you. So if you're on that latter portion of Americans, then paying down debt should be a priority. If you're not properly leveraging debt, then that would mean that your debt is weighing you down. So putting $5,000 into debt would probably be the best option for you. But if you're not leveraging debt, then it wouldn't make sense to pay it. Well, if you are leveraging debt, you may want to be using those for to increase your leverage and increase your exposure to the market to get those proper returns. Now, with the lowest one was other, but we'll skip that portion for now. But there was a tie between putting $5,000 into a CD or investing into the market. This is where it gets kind of odd. A CD pays higher than a high yield savings account. The market, and we're talking about June 21st. If we were to invest $5,000 into the market as of now, that would probably probably would be your best bet. At least if I were to use those $5,000, I would, that would be the most attractive piece of the pie. Why do I say that? Well, we are experiencing a difficult financial stresses this year. Are we betting that the market will continue to be going on a downward trend? What would that look like? Well, if that would happen, then we have other things to worry about. Not just the market, but our livelihood. But that's just me. I would honestly find that piece of the pie the most attractive. Okay. Anyways, that's something for you guys to see, and it's go shopping. That's also somewhere in the middle and funny. Yeah, shopping should be your last option. That should be the smallest pie. Okay, and I also wanted to show y'all, not that, that's here, I showed you guys that. I wanted to show you, this is a graph that was quite comical. So this is a chart that tracks the growth of $100,000 in the monthly net flows for Morningstar moderate allocation category, and you see this trend. Um, it is a it compares it to a 60-40 bond mix, which you see they're very comparable. Those two are the market and that 60-40 blend. It's a they're very similar. But you look at the peak right before 2008. This is what we were talking about earlier about investing with your emotions. When you see an upward trend, you feel happy that, hey, look, I'm so happy I invested when I did. It feels good in the short term. But then, and I have felt this. I remember feeling this. It's a very visceral response when you see wild fluctuations in the market. It's hard to stomach. I do agree. It's hard to stomach. I remember in 2018, I remember seeing the crash obliterate my cash. I was like, whoa, this is rough. I remember thinking, I hope to, it's like I need to pull out as soon as I can because this is dangerous. But then common sense kicked in. So, hey, things are reacting to a global pandemic, and chances are that at least our nation will protect its economy as much as it can, especially when Trump was in office. And so you had to bet for that. And I remember convincing my wife to take most of our savings and dump them into. I think and I wasn't being. I don't remember being very aggressive or risky, but I remember dumping a bunch of money into Vanguard. I think it was the total stock index. And yeah, it was fruitful, profitable. As soon as we started dollar cost averaging out of the market, it paid off quite well. But it was, again, a very visceral response. But yeah, once the market goes down, you start seeing a downward trend. That's when you want to pull out as quickly as you can because that's your natural response and it makes sense. So yeah, I thought that this was a very comical little chart. So yeah, this is very telling on how we as humans react to our decisions, or how we react to things that are attractive and things that are repulsive. Economic highs are very attractive and economic lows are very repulsive. But anyways, yeah, that's all for today. I thought I would share that. And as far as other things go, the market, I don't think there has been much movement, but it does seem like we are going in an upward direction, which is a good thing. But yeah, that's all for today, and see you next time. God bless you all.